Welcome to the October 2025 Evergreen Asset Allocation Committee meeting. Without further ado, let's start the meeting with an economic update by MAV. Global Economic Conditions and Monetary Policy Trajectories. Dr. Peter Mavromatis, MAV, opened discussions by highlighting the divergent economic conditions and policy responses across major economies. The United States experienced a government shutdown, resulting in delayed release of critical economic data, including the typically punctual employment figures normally published on the first Friday of each month. This has created an unusual information vacuum for market participants during October. The Federal Reserve had recently recommenced its cutting cycle with a 25 basis point reduction, motivated primarily by perceived softness in the labor market. However, MAV contested this interpretation, arguing that labor market weakness largely reflected demographic shifts rather than genuine economic deterioration. He noted that the United States has recorded zero net migration in 2025 so far, significantly impacting labor supply growth. The break-even jobs rate had consequently fallen from approximately 100,000 to 150,000 jobs monthly to closer to 50,000 jobs monthly. Market pricing indicated full expectation of further rate cuts at both the 29th of October and pre-Christmas Federal Open Market Committee meetings, implying two additional 25 basis point reductions for 2025. Looking forward, markets anticipated nearly 5 rate cuts over the subsequent 12 months. MAV expressed substantial reservations regarding this policy trajectory, arguing the Federal Reserve was likely committing a policy error. He observed that the Fed's 2% inflation target for personal consumption expenditures had not been achieved since October 2018, representing 7 years of persistent deviation. With emerging inflationary pressures from trade disruptions and companies signaling intentions to pass higher costs to consumers, MAV considered the timing of cuts premature. He suggested a weaker economic period might materialize mid-2026, at which point the Fed would have already exhausted considerable policy capacity. Additionally, the Federal Reserve announced an unexpected early termination of its quantitative tightening program, effectively ending balance sheet reduction whilst simultaneously cutting rates, creating conditions conducive to sustained liquidity and potential inflationary pressures. Trade tensions and rare earth minerals, strategic implications. Dr. Kingsley Jones provided detailed analysis of escalating trade tensions between the United States and China, particularly regarding rare earth minerals and magnet production. Approximately 1 week prior to the meeting, markets experienced sharp sell-offs following China's imposition of additional export controls on rare earths, prompting President Trump to impose an additional 100% tariff on Chinese imports and threaten cancellation of scheduled November meetings with President Xi Jinping. Jones identified fundamental misunderstandings within United States leadership regarding domestic rare earth capabilities. The Mountain Pass mine, America's largest rare earth operation, exports the majority of its concentrates to China for processing and has grown from 0 to 40,000 tons annually of rare earth oxide since restarting in 2017. During this period, Mountain Pass captured market share from Australia, whose production increased merely 8% over 10 years, from 15,000 tons to 11,000 tons. Whilst global production expanded threefold from 130,000 tons to 290,000 tons annually. Jones emphasized that the critical vulnerability lies not in rare earth minerals themselves, but in magnet production, where China commands over 90% of global output. The United States represents approximately 3% of global magnet demand and 1.6% of rare earth demand, whilst producing roughly 10% of global rare earth output. China's withholding of magnets would inflict substantial damage on American technology manufacturing capabilities, whereas restricting rare earth exports would prove largely inconsequential. The rare earths in question, primarily lanthanum and cerium, trade at approximately $2 per kilogram, whilst praseodymium and neodymium command $40 to $60 per kilogram. Given historical magnet demand growth rates of 7% annually, losing 3% of total market demand represented negligible impact for China. Jones characterized the situation as asymmetric, with China holding commanding strategic advantage. He anticipated China would leverage this position during negotiations, potentially humiliating American negotiators with demonstrations of their insignificance in global rare earth and magnet markets, whilst the United States would respond with further tariff escalations in what he termed ongoing brinkmanship. Equity market valuations and bubble formation risks. MAV presented compelling evidence regarding elevated equity valuations and increasing concentration risks in United States equity markets. The October Bank of America Global Fund Manager Survey revealed that 54% of respondents believed artificial intelligence stocks were in bubble territory, representing substantial increase from approximately 40% in August and September. Even so, investors continued participating in this momentum trade despite bubble concerns. Gold emerged as the most crowded trade, surpassing the Magnificent Seven technology stocks, with nearly 40% of respondents holding no gold exposure and approximately 20% maintaining positions of 2% or less, suggesting potential for continued upward price momentum. Third quarter earnings data from FactSet indicated earnings growth approaching 8%. With projections for 13% earnings per share growth, representing the fourth consecutive quarter of double-digit growth. Notably, actual earnings per share growth exceeded consensus forecasts in 37 of the previous 40 quarters, suggesting systematic underestimation by analysts. Valuation metrics presented concerning signals across all market segments. The Nasdaq traded at nearly 30 times forward earnings, positioned at the top of its 20-year historical range. The S&P 500 traded above the 95th percentile of its 20-year distribution, indicating pricing for perfection across large capitalization stocks. These elevated valuations prompted recent portfolio adjustments favoring small and mid-capitalization stocks, where relative value opportunities appeared more attractive. Jones contributed further important observations regarding market dynamics, noting that households represented 40% of market participants with lower turnover characteristics compared to institutional investors. Households preferentially purchased household name stocks, creating mutually reinforcing concentration dynamics as the Magnificent Seven continued delivering strong earnings. He referenced Peter Thiel's advocacy for monopolistic market positions, arguing many United States companies had achieved commanding positions enabling rent extraction. Jones identified emerging financial engineering practices, citing examples where NVIDIA provided capital to OpenAI ostensibly for chip purchases, characterizing such arrangements as mechanisms to sustain earnings growth momentum. He assessed that whilst not yet in bubble territory, probability of bubble formation within 12 months was elevated, drawing parallels to both the 1920s boom and the Gilded Age robber baron era characterized by concentrated economic power among industrial trusts. Mav noted that intense concentration risk meant disappointment from merely one or two mega-capitalization companies could trigger substantial market corrections, though timing remained the proverbial $64 question. Australian monetary policy settings and labour market assessment. The Reserve Bank of Australia maintained notably different policy trajectory compared to the Federal Reserve. Market pricing previously indicated high confidence in November rate cuts, but following release of September meeting minutes, exhibiting more hawkish tone, expectations shifted dramatically. Markets now anticipated only one rate cut by early February, with possibility of a second cut uncertain. This contrasted sharply with expectations of 5 United States rate cuts over 12 months. Mav considered this divergence appropriate, arguing the Reserve Bank of Australia correctly assessed the Australian economy as only modestly restrictive. He calculated the nominal neutral cash rate for Australia at approximately 3.25%, meaning 1 or 2 25 basis point cuts would bring policy close to neutral without providing substantial economic stimulus. The September Reserve Bank meeting produced unanimous decision to hold rates unchanged, unlike the divided July decision. Recent public commentary from both Governor Michelle Bullock and Chief Economist Dr. Sarah Hunter suggested labour market conditions remained somewhat tight, though Mav disputed this characterisation. Data presented showed the unemployment rate drifting upward from mid-2022 levels, moving from extraordinarily tight full employment conditions to current levels slightly below full employment. Mav observed particular weakness in retail and low-skilled employment sectors. He noted artificial intelligence displacement effects emerging in programming occupations, citing personal experience where cheap AI software completed complex development work in a matter of days that would traditionally require several months and cost $40,000 to $50,000. Monthly inflation data showed headline consumer price index at 2.8% and 3.0% for recent observations, influenced substantially by timing of electricity subsidies. The trimmed mean measure, representing underlying inflation, declined from 2.7% to 2.6% in August, providing confidence regarding trajectory toward the Reserve Bank's target band midpoint. However, a core inflation measure excluding volatile items accelerated from 3.2% to 3.4% over the same period, creating somewhat conflicting signals. The forthcoming September quarter Consumer Price Index release would prove critical in determining whether the Reserve Bank proceeded with rate cuts. Mavitt assessed odds as better than 50-50 for November cut, contingent on quarterly inflation data not surprising materially above expectations. He noted it was unusual for economists to express greater optimism than market pricing implied. Should a cut eventuate, bringing the cash rate to approximately 4.1%, with potential second cut reaching 3.85%, policy would approach neutral settings whilst providing modest relief to households with variable rate debt without constituting substantial stimulus. Post this part of the meeting, the ABS released labour market data for September, revealing a 20 basis points jump in the headline unemployment rate to 4.5%, but trend unchanged at 4.3%. Driven by higher workforce participation. Cash rate futures traders subsequently moved to increase bets of a November rate cut. Resolution. Capital Global REITs Update. Global REIT Opportunity Set and Sector Composition. Julian Campbell Wood, Portfolio Manager at Resolution Capital, provided a comprehensive overview of the global real estate investment trust universe, emphasizing the breadth of sectors available beyond traditional office, industrial, and residential property. The composition of the global REIT universe has evolved considerably over the past 6 years, with office property now representing approximately 9% of the opportunity set, whilst alternative sectors including industrial, healthcare, self-storage, data centres and cell towers have expanded their representation. The healthcare real estate sector in North America operates under a distinct cash rental model, fundamentally different from the Australian market, particularly focusing on rental seniors housing where investors gain exposure to underlying operational performance. The retail sector encompasses high-quality shopping centres, including former Westfield assets in Europe and the United States, as well as grocery-anchored centres, which tend to be larger than their Australian counterparts. Residential property within the global context presents a materially different investment proposition compared to Australia, with current yields exceeding 6% and rental growth ranging from 2 to 5%. Representing genuine cash flow investments rather than capital appreciation plays. The data centre sector, whilst experiencing substantial attention due to artificial intelligence developments, has seen its listed opportunity. Set contractors private equity firms have taken 5 platforms private in recent years. Self-storage represents an attractive asset class characterised by minimal capital requirements to maintain cash flow, with maintenance costs comprising only 3 to 5% of income compared to 30 to 40% for office buildings, thereby creating a significant disparity between headline capitalisation rates and effective cash returns to investors. Campbell Wood noted that Resolution Capital's current portfolio positioning reflects strong conviction in healthcare, overweight, data centers, and self-storage based on fundamental characteristics including demand-supply dynamics and landlord pricing power. Conversely, the firm maintains reduced exposure to industrial real estate, hotels, and office property due to less favorable fundamentals. The industrial sector specifically experienced significant supply increases during the COVID period when capital was readily available, resulting in elevated vacancy rates and softening rents. However, Campbell Wood emphasised the advantage of global diversification, noting that even within challenged sectors such as office, certain markets demonstrate healthy fundamentals, citing Tokyo's office vacancy rate of approximately 2.5% in the main 5 wards and London's West End at around 5% vacancy, contrasting sharply with mid-teen vacancy levels in Australian markets. Geographic allocation and recent performance dynamics. The geographic composition of global REIT portfolios reflects the dominance of North American markets, with the United States comprising a substantial portion of the opportunity set due to market size, liquidity, and decade-long performance strength. Campbell Wood explained that the US market provides access to all property sectors with large internally managed platforms possessing robust balance sheets, offering managers the ability to position portfolios defensively or offensively across various property types despite apparent geographic concentration. The United Kingdom and Europe collectively represent approximately 12 to 13% of the global opportunity set, though Resolution Capital's portfolio shows 10% UK exposure reflecting tactical positioning. Australia comprises 5% and Japan 9% of the global universe, with managers able to exploit different fundamental conditions and varying positions within macro cycles across these regions. Campbell Wood highlighted a critical distinction in refinancing dynamics, noting that Singapore, Hong Kong, and Australia have experienced interest rate declines to levels where marginal finance costs for REITs now sit below their in-place cost of debt, creating refinancing tailwinds. This contrasts with the United States, Europe, and the United Kingdom, where companies continue facing headwinds whilst working through lower-cost debt refinancing. The sector's performance over recent years has proven underwhelming relative to global equities, though Campbell Wood provided important context regarding currency effects and appropriate performance benchmarks. For Australian dollar unhedged investors, global REITs generated reasonable 5-year returns, though hedged returns were several hundred basis points lower due to Australian dollar devaluation. Campbell Wood acknowledged that global equities delivered 17% returns over the 5-year period, substantially outperforming REITs, driven particularly by US technology and artificial intelligence exposure. However, he emphasized that REIT return profiles should properly sit between bonds and equities, incorporating a distribution component underpinning total returns alongside growth elements from cash flow expansion. He noted the unusual investor expectation of 20+% compound returns characteristic of equities, given the different return on equity profiles between asset classes. The firm manages portfolios identically for both hedged and unhedged investors, with product choice reflecting client preference regarding currency risk, though Campbell Wood indicated his personal preference for unhedged exposure as a long-term investor, whilst acknowledging that extreme currency levels, near parity or 50 cents, might influence marginal investment decisions regarding hedged versus unhedged allocations. Fundamental drivers and replacement cost dynamics. Campbell Wood emphasised that whilst the past 5 years have proven lacklustre for REITs, with hedged absolute returns generating investor frustration, the underlying fundamentals have strengthened considerably. The sector has contended with significant interest rate shifts affecting discount rates, with bond returns similarly underwhelming over the 5-year period, reflecting this dynamic. COVID-related disruptions proved differentially impactful across asset classes, whilst competition for capital within the alternatives bucket intensified, with global listed infrastructure attracting capital due to strong returns and private credit experiencing substantial growth. However, Campbell Wood stressed that focusing on past returns provides misleading guidance, noting that in 2006, when the sector delivered 30% compound returns, the underlying fundamentals were substantially weaker than current conditions, with higher development activity, elevated payout ratios, and rich multiples preceding underwhelming forward returns. He contrasted this with the present environment, where despite poor recent performance, fundamental underpinnings appear considerably more robust, suggesting more attractive prospective return outlooks. Data from US markets demonstrates that institutional quality commercial real estate has broadly underperformed over 5 years, with direct property returns from major managers operated by GPT, DEXUS, and MIRVAC, alongside sovereign wealth funds including GIC, Ardian, and CPPIB, delivering meagre returns comparable to REIT performance, indicating sector-wide rather than structure-specific challenges. Real estate fundamentals ultimately depend on three critical factors: demand-supply dynamics, capital structures, and replacement costs, with valuation representing an additional consideration. Campbell Wood stressed that whilst interest rates matter in the short term through discount rate mechanisms, underlying fundamentals drive returns over time, cautioning that low interest rates coupled with massive oversupply still generate poor returns. He cited UK shopping centres pre-COVID as illustrative, where despite declining interest rates and very low real rates, values fell 50% with rents subsequently declining 30%, and total asset values dropping 60% due to fundamental demand-supply mismatches. Supply analysis reveals divergent sector dynamics, with US retail real estate experiencing minimal new supply for 15 years since the global financial crisis, with new stock running at approximately 50 basis points annually, approaching building obsolescence rates. This limited supply, coupled with growing demand as retail activity returns to physical stores, underpins strong performance. Conversely, industrial property experienced a massive supply spike during COVID, with new buildings as a percentage of existing stocks surging dramatically, resulting in elevated vacancies and falling rents as the sector works through this adjustment. Healthcare real estate operates with supply below 1.5% despite massive demand surges, whilst multifamily construction runs near longer-term averages. The replacement cost dynamic represents a critical component of the current cycle, with construction costs increasing 25 to 40% over the past 5 years. Campbell Wood referenced Zurich Insurance data showing the property price index construction costs increasing substantially whilst building values declined approximately 20% in the US, UK and Europe, with Australian markets experiencing 10 to 15% declines depending on sector. This divergence creates a situation where development becomes extremely difficult to justify economically, as building values sit materially below replacement costs, removing developer incentives for new construction. Whilst acknowledging development has not ceased entirely, with data centres remaining highly profitable and specific projects like Sydney's Chifley Tower and 55 Pitt Street proceeding based on zero or very low land basis, Campbell Wood stressed that across most sectors, development economics fail to stack up. This dynamic represents a normal real estate cycle component, with resolution occurring as rents and values increase over multiple years until exceeding replacement costs, at which point development economics improve. This rent growth, driven by economic rents relative to replacement cost rents, represents a key expected driver of returns over the 3 to 5 year horizon, alongside healthy occupancy levels across most sectors, office being the clear exception, providing landlords with pricing power to drive rents and cash flow growth. Capital structures, valuation metrics, and sector outlook. Capital structure analysis reveals the REIT sector in substantially stronger condition compared to historical periods of stress. Campbell Wood noted that during the global financial crisis, Australian REITs maintained excessive leverage, problematic cross-currency hedges, and excessive development exposure, leading to poor investor outcomes including distressed rights issues. Similarly, UK REITs experienced comparable difficulties during that period. Current US REIT sector leverage, measured at 5.5 times debt to EBITDA, translates to loan-to-value ratios of approximately 30% or slightly lower, representing manageable levels substantially below private real estate market leverage. This modest leverage applies to property values that have already corrected 15 to 20%, indicating balance sheets in robust condition. REITs possess superior capital access compared to private investors through unsecured bond markets, currently experiencing record low credit spreads across both investment grade and high yield segments, which REITs actively utilize. Other markets, including the US, UK, and Australia, maintain reasonable debt to EBITDA levels, though certain Asian markets operate with higher leverage, resulting in reduced portfolio exposure from Resolution Capital's perspective. However, Campbell Wood emphasised that REIT sector leverage remains materially lower than private market comparables, with the sector typically maintaining investment-grade ratings and accessing both bank debt and unsecured bond markets. The earnings outlook for the Resolution Capital universe of 140 internally modelled global securities indicates bottom-line earnings growth accelerating in coming years following post-COVID adjustment. Current portfolio positioning in sectors with superior return profiles targets 5 to 6% earnings growth over the next 3 years, combining with gross portfolio level distribution yields of approximately 4% to generate high single-digit to double-digit total returns without multiple expansion. Campbell Wood referenced historical data indicating REITs delivered 8 to 9% compound returns over 30 years, comprising approximately 4.5% cent distributions, with the remainder from cash flow growth and capital appreciation. Noting this baseline shifts depending on property cycle positioning. The sector currently trades at approximately 15% discount to net asset values that have themselves corrected approximately 30%, accounting for leverage against the 15 to 20% property value declines, representing undemanding, though not distressed valuations. Campbell Wood stressed this analysis excludes replacement cost dynamics, representing discounts to static values, which should underpin returns over 3 to 5 years as rents grow towards replacement cost levels. The investment case strengthens when considering that property values have begun inflecting positively across most regions and sectors following the adjustment period, initially driven by rental growth, though not yet accompanied by normalised transaction volumes. Campbell Wood presented data showing global property transaction volumes remain suppressed, though anticipated to recover as base rates decline in various markets and property values stabilise, serving as an indicator of continued real estate cycle progression. Relative valuation metrics demonstrate REITs trading at substantial discounts to global equities over the past 20 years, representing Resolution Capital's strategy history, with current discount levels having precedent those sustained divergence being unusual, though Campbell Wood declined to predict reversion timing. Global REIT universe multiples sit around longer-term averages rather than distressed levels seen during the global financial crisis or COVID, yet appear competitive given value corrections, accelerating rent and value growth, and elevated pricing across many global asset markets. The UK market specifically illustrates valuation dynamics, with REITs trading cheaply relative to underlying real estate, prompting Blackstone to announce interest in acquiring platforms such as Big Yellow Group within the past fortnight, representing typical private equity behaviour when listed REITs trade at meaningful discounts to underlying property values. Though Campbell Wood expressed mixed sentiment given preference for retaining high-quality public platforms despite value realisation benefits. 4D Infrastructure Global Infrastructure Update. Infrastructure investment, fundamentals and growth dynamics. Sarah Shaw, Chief Investment Officer at 4D Infrastructure, presented a comprehensive case for infrastructure investment, positioning it as one of the most significant opportunities over the next 20 to 30 years. She articulated that infrastructure combines defensive characteristics traditionally associated with the asset class alongside substantial growth dynamics and sectoral diversity. The defensive attributes stem from monopolistic market positions, high barriers to entry, earnings underpinned by contracts or regulation, inflation hedges, both explicit and implicit, high upfront capital costs with low maintenance expenditure, and scale advantages. These characteristics collectively generate long-term visible and resilient earning streams that support both yield and growth profiles whilst maintaining lower earnings volatility. Shaw identified 5 integrated growth dynamics that must occur regardless of political leadership, geopolitical circumstances, or economic conditions. The first dynamic concerns developed market replacement expenditure, with infrastructure across developed economies deteriorating critically. In the United States, over 75,000 bridges have exceeded their useful life, whilst wooden water pipes over 100 years old remain in service. Germany faces similar challenges, with 1 in 3 railway bridges exceeding 100 years of age. The German stimulus program announced earlier in the year prioritised infrastructure over defence spending because existing road and rail networks cannot support the weight of tanks planned for defence procurement. Population growth constitutes the second major driver, with global population expected to grow from 8 billion to over 10 billion at peak. This growth diverges geographically, with the East experiencing a younger demographic profile whilst the West ages, each requiring different infrastructure investment types. The third dynamic involves the emergence of the middle class in developing economies, where 86% of the global population resides in emerging markets. Shaw emphasised that as this demographic evolves, infrastructure serves as both the primary driver and first beneficiary of their advancement, beginning with basic needs such as clean water and indoor plumbing, progressing through increased electricity usage for appliances, and ultimately requiring comprehensive logistics chains, including roads, rail, port capacity, and airports. The fourth dynamic addresses the energy transition, with current global spending of $1.5 trillion on clean energy requiring expansion to $4.5 trillion annually to achieve net zero targets, with 2/3 necessarily originating from emerging markets. The fifth dynamic concerns technology advancement, particularly artificial intelligence, which requires substantial investment in telecommunications towers and power infrastructure. Shaw noted that load demand growth projections have reached the highest levels in decades, driven primarily by technological evolution. Emerging markets exposure and investment approach. Kingsley Jones raised concerns regarding infrastructure investment access in emerging markets, noting China's significant power generation capacity and growth rate relative to the United States, alongside Chinese firms' dominance in emerging market infrastructure development and financing. Shaw acknowledged the complexity whilst maintaining that opportunities remain accessible through selective country and asset targeting. She explained that 4D Infrastructure conducts country risk assessments prior to considering any emerging market investments, evaluating economic risk, financial risk, political factors, and sustainability objectives. A critical requirement involves the strength of judicial systems capable of upholding regulation or contracts supporting investments. Without this judicial foundation, countries are excluded from consideration regardless of other attractive attributes. When countries meet acceptance criteria, 4D Infrastructure prioritizes investment in grid networks, specifically transmission and distribution infrastructure, at both developed and emerging market levels. These grid operators generally trade on listed markets rather than unlisted arenas, typically operating under regulated environments where regulators dictate investment returns based on capital deployed. Shaw emphasised that investors earn regulated returns on investment dollars committed under these frameworks. This structure provides investment opportunities across multiple jurisdictions, possessing strong judicial systems and regulatory models supporting appropriate returns within listed markets. Shaw acknowledged that not every country presents investable opportunities, but stressed the scale of required investment creates sufficient accessible opportunities. She noted that $100 trillion of infrastructure investment is required by 2040, with only 10% needing to reach listed markets to quadruple the investable universe. Furthermore, she highlighted that emerging market infrastructure demonstrates substantially higher quality than developed market equivalents, addressing concerns about asset standards. The middle-class evolution in emerging markets currently operates with one-third of the energy consumption per capita compared to developed markets, necessitating green energy adoption from the outset of their development trajectory to achieve global energy transition goals, thereby compounding investment requirements alongside middle-class emergence. Interest rate sensitivity and sector positioning. Shaw addressed infrastructure's correlation with interest rates and economic conditions, emphasizing the importance of active positioning between regulated utilities and user-pay assets to capitalize on varying economic environments. Regulated utilities or regulated assets demonstrate substantial immunity to economic shifts due to volume independence, earning returns over investment dollars committed, but exhibit correlation to interest rates because investment returns link to interest rate movements. Conversely, user pay assets including toll roads, airports, ports, and rail companies demonstrate 100% correlation to economic activity, with GDP driving volumes. These assets incorporate explicit inflation hedges and generally operate high-margin businesses, reducing cost inflation sensitivity. Shaw presented analysis of the largest interest rate rising and subsequent falling cycle of the past 20 years surrounding the global financial crisis, demonstrating listed infrastructure outperformed through active positioning. User pay assets drove performance during economically buoyant periods, whilst regulated utilities provided downside protection, avoiding the severe declines experienced by general equities and user pay assets during the economic collapse. This dynamic enables overweight positioning in user pay assets during periods of strong GDP growth, rising inflation, and increasing interest rates, then shifting towards regulated utilities during deteriorating growth and interest rate environments similar to COVID-19 conditions. Mav questioned whether analysis had been conducted mapping different infrastructure assets against longer-term real yields rather than short-term policy rates, suggesting real yields, particularly 10-year real yields, exert more significant influence. Shaw acknowledged the relevance to fundamental valuations and weighted average cost of capital calculations, noting differentiation between assets considered bond proxies and those without such characteristics. She identified United States utilities as the only segment within the infrastructure universe classified as bond proxies, attributable to their lack of direct inflation, pass-through mechanisms, and absence of formulaic regulatory models. This created historically tight inverse correlation between U.S. utilities and U.S. 10-year Treasury yields, which Shaw noted exhibited remarkable tightness through 2022 and 2023 during high inflation periods. However, this historical correlation broke in early 2024, which Shaw attributed to the artificial intelligence thematic. Charts presented demonstrated that whilst interest rate dynamics shifted substantially, required returns on equity for U.S. utilities only partially increased. Consequently, utility return profiles currently trade below historical spreads to treasuries, suggesting the decades-long price earnings expansion for U.S. utilities has concluded. Despite this, U.S. utilities have demonstrated significant earnings per share growth acceleration, with annualized EPS growth from 2024 onwards substantially exceeding any period since the global financial crisis, occurring during a normalized interest rate environment rather than zero rates. Consensus expectations anticipate EPS growth well ahead of historical achievements through 2027, driven by artificial intelligence thematics, data center build-out requirements, energy transition investments, and replacement expenditure. Shaw noted that historical price earnings expansion occurred during the bond proxy trade when EPS growth approximated 3 to 4%, whereas current price earnings ratios have returned to historical averages despite dramatically increased EPS growth forecasts, explaining the divergence from Treasury yields. Geopolitical risks and portfolio positioning. Shaw identified interest rate direction and Trump administration policies as primary risks for 2025 and 2026, with tariffs creating particular uncertainty. Following Liberation Day, 4D Infrastructure conducted detailed analysis assessing tariff impacts across infrastructure sectors and regions. The United States emerged as the most impacted region, with concerns extending to US utility analysis. Tariff impacts on infrastructure manifest through multiple channels. Economic impacts reducing activity levels alongside inflation, constraining interest rate adjustment capacity. Shifting volumes in North American rail networks due to altered export-import dynamics evidenced by Chinese exports redirecting from the United States to other destinations, and Brazilian soybeans replacing American exports to China. And supply chain cost increases for utilities amid substantial growth programs, compounded by regulatory or state-level affordability concerns given weakening consumer conditions. These dynamics create challenging circumstances for the Federal Reserve whilst maintaining overhanging concerns for US infrastructure despite attractive growth thematics. Shaw noted the US utility growth thematic remains appealing, but highlighted that grid and network thematics can be accessed in other global regions, demonstrating greater insulation from geopolitical overhangs. This analysis supported 4D Infrastructure's overweight positioning in Europe and Latin America during the year, which Shaw reported had performed well, whilst maintaining US exposure given the compelling growth thematic, but acknowledging continued overhangs. Shaw additionally highlighted that historically, US dollar weakness proves bullish for emerging markets. With the US dollar declining 10% year to date and appearing not effectively cheap, further weakness could materialize. Combined with divergent global interest rate trajectories, varying thematics across regions, and geopolitical overhangs, Shaw emphasized substantial complexity in positioning portfolios to capitalize on long-term thematics whilst managing short-term cyclical dynamics. She noted thematics must occur regardless of external factors, but short-term positioning becomes challenging given rapidly shifting conditions. Regarding current valuation opportunities, Shaw presented data demonstrating infrastructure has underperformed general equities since COVID-19 despite superior fundamental performance. Infrastructure has delivered positive earnings growth throughout the past 20 years, including through the global financial crisis, COVID-19, and inflationary spikes, with substantially lower volatility than general equities. Annualized earnings growth has outpaced general equities over this period and since COVID-19, yet infrastructure has underperformed on a price basis. She noted that whilst the Magnificent Seven technology stocks drive general equity performance, they are incorporated within general equity earnings growth forecasts, rendering the performance gap between infrastructure and general equities unjustified and presenting significant opportunity for increased allocations. Observed that earnings growth has not matched price performance across numerous equity market segments, not uniquely affecting infrastructure. He noted that developed global infrastructure has delivered approximately 8 to 9% per annum over the period, meeting expectations, and he expressed no disappointment with performance outcomes, suggesting the comparison to markets that have skyrocketed may be inappropriate. Shaw conceded infrastructure has delivered promised returns of 8 to 9%, but emphasised that earnings fundamentals have substantially outperformed historical norms due to ramped growth dynamics not yet recognised by markets. She provided a detailed example of a UK electric utility that historically delivered 3 to 4% regulatory asset base RAB growth, translating to 4 to 5% earnings growth with inflation hedge, and 4 to 5% yield, totaling 8 to 9% returns. Looking forward to 2035, the identical utility faces 12% per annum RAB growth with upside risk, alongside a 3% inflation hedge, implying 15% per annum earnings growth to 2035 without operational efficiencies, a seismic shift from historical 2 to 3% RAB growth. Shaw argued this fundamental improvement necessitates higher delivered returns than historical 8 to 9% outcomes.
Mav,
Also questioned whether distributions had disappointed, potentially explaining price performance. Shaw presented data showing infrastructure averaged 4.2% yield versus 2.4% for general equities consistently over 20 plus years, indicating no disappointment on yield delivery.
Mav,
Noted this 4.2% yield matches global REIT's total return over 10 years on a developed country currency hedged basis, suggesting infrastructure has remained true to label with good outcomes. He sought clarification on whether Shaw's argument centres on expecting enhanced returns due to thematic tailwinds awaiting market recognition. Shaw confirmed this interpretation, noting that historically regulators held excessive power and could crimp returns, particularly in the UK. But bargaining power has shifted to operators and grid investors. Capital scarcity, dire network conditions from ageing infrastructure, failure to accommodate new generation sources, and technology load demand growth have forced regulators to approve substantially increased investment programs. Companies now refuse investment without adequate regulatory returns, exemplified by Iberdrola, which invests in grids globally, including the UK, Spain, the US, and Brazil, and recently pressured Spanish regulators to improve returns or face capital reallocation to jurisdictions offering superior regulatory frameworks. Shaw concluded that governments cannot fund required investments, creating circumstances where operators possess leverage to demand appropriate returns, fundamentally altering the regulatory dynamic from historical periods. Discussion. Economics. The committee commenced its analysis by reflecting on the presentations from external managers covering REITs and infrastructure sectors. Members observed what they characterised as a potential regime shift in how these assets might be valued prospectively versus retrospectively. The REITs presentation highlighted broad-based opportunities emerging from changing investor flows over the past decade, with significant capital having migrated from listed GREIT structures toward unlisted private credit vehicles. The committee noted that this shift, driven by higher income expectations in riskier unlisted formats, may have created valuation anomalies worth monitoring. The infrastructure discussion proved particularly nuanced, with members examining the regulatory and political dimensions affecting utility and infrastructure performance. The committee acknowledged the structural growth opportunity in emerging markets, where most global population resides, and infrastructure requirements remain substantial. However, members expressed reservations about Western investment universe access to these opportunities, noting that much EM infrastructure development would likely be financed and constructed by Chinese and BRI CS-aligned companies. The committee identified select opportunities where attractive positioning might be achieved despite these structural challenges. The committee drew particular attention to current market dynamics, characterising the environment as one where Mag 7 concentration has created an investment pulse, potentially dragging other assets along, though at different multiples. Members viewed this dispersion as potentially creating differentiated investment opportunities. The committee also noted the latest Australian employment data showing unemployment rising to 4.5%. Though members observed this increase was partially attributable to higher participation rates, with trend figures remaining stable at 4.3%. This development was discussed as potentially providing the RBA with justification for an additional rate cut, even if inflation data proved somewhat disappointing. Portfolio construction. The committee reviewed its current asset allocation positioning and agreed to implement one modest adjustment to the growth portion of the portfolio. The overall growth defensive split remained slightly tilted toward growth assets at approximately 64%-36%, maintaining the overweight position established the previous month when 3 percentage points were shifted from defensive to growth assets. Members expressed satisfaction with the current growth asset composition, particularly noting the improvements made over the preceding 6 months. The committee reaffirmed its overweight position in alternatives, primarily comprising gold and silver exposures, with members observing sustained demand evidenced by unprecedented queues at physical bullion retailers. The committee noted precious metals momentum remained robust, with platinum and palladium showing significant recent appreciation, and saw no indicators suggesting reversal of the gold rally despite potential moderation in pace. Members discussed the relationship between cryptocurrency and precious metals performance in terms of funding sources for each other across quarterly periods, viewing this dynamic as supporting the continued alternatives overweight amid ongoing geopolitical uncertainty. Following discussion of potential funding sources for further growth asset exposure, the committee identified Australian duration as the appropriate candidate for modest reduction rather than credit exposure. Members acknowledged that while credit spreads remained exceptionally tight, they reflected robust economic fundamentals and therefore warranted retention. The committee agreed to reduce Australian duration by 1 percentage point to 9%, deploying this allocation toward global equities to bring that position to 16% and achieve closer alignment between domestic and international equity weights. This adjustment was characterised as modest and consistent with the committee's preference for international over domestic equity exposure. Members noted that while 1 percentage point variance was not materially detrimental to returns, the symmetry improvement was considered appropriate given the limited compelling case for duration exposure beyond its hedging characteristics. The committee agreed to maintain its current positioning across other asset classes, including the underweight to defensive assets overall, minimum cash holdings, and overweight to high-quality credit. Members expressed continued interest in real assets opportunities medium term, particularly following the day's presentations, whilst maintaining a watching brief on potential additions to this exposure.